Hey there, investors. Today's video is all about understanding how the Federal Reserve's recent 0.50% rate cut affects you and the global economy. Let's dive right in. So, why does the Fed cut rates? The main idea is to stimulate economic activity, especially when growth is slowing or during a recession. Lower interest rates reduce borrowing costs, encouraging both consumer spending and business investments. Historically, we've seen the Fed use rate cuts effectively, like during the 2008 financial crisis and the 2020 pandemic. But what does this latest cut mean for the US economy right now? First, a 0.50% rate cut lowers borrowing costs for everyone: consumers, businesses, and even the government. Lower interest rates mean cheaper loans, mortgages, and corporate debt, which typically lead to increased spending and investment. This boost in spending can drive short-term GDP growth thanks to the multiplier effect. However, there's a flip side. Lower interest rates can put upward pressure on inflation. The Phillips curve shows that as unemployment decreases, wages and prices tend to rise. If inflation expectations get out of hand, the Fed might face a tough choice between stimulating growth and keeping prices stable. Now, let's look at the global implications. The UK is closely tied to the US through trade and financial markets. A weaker dollar could make British exports more competitive, but Brexit and other challenges could complicate things. In China, the rate cut might reduce capital inflows into the US, prompting investors to look at emerging markets like China. This could strengthen the yuan and boost Chinese exports. Yet, if the cut signals a slowing US economy, Chinese exports might suffer. Japan, battling deflation for years, could benefit from a weaker dollar, boosting its export competitiveness. However, structural issues like an aging population could limit these benefits. For India, a US rate cut could mean more capital inflows and investor confidence, benefiting sectors like infrastructure and technology. The Reserve Bank of India might also lower rates, boosting borrowing and spending. But inflation, especially in food and fuel, remains a concern. So, what should investors do? Reassess your portfolios, focusing on sectors that benefit from lower rates like technology and consumer discretionary. Diversify into international markets and consider commodities like gold as a hedge against inflation. Banks, on the other hand, need to prepare for reduced net interest margins. They should shift towards fee-based income and non-interest revenue streams, while also adjusting lending criteria to capitalize on increased borrowing activity. Countries outside the US must navigate the complex implications. Central banks in developed economies might face pressure to cut rates, while emerging markets should monitor capital flows closely to manage currency volatility. To wrap up, a 0.50% rate cut by the US Fed has significant implications for both the US and global economies. While it may boost economic activity and investor sentiment in the short term, the long-term effects will depend on inflation, international trade, and structural economic conditions. Investors, banks, and policymakers must stay vigilant and adapt their strategies to this evolving landscape. Thanks for watching. Don't forget to like, subscribe, and hit the bell icon for more insights. See you next time.